India's markets are poised for a structural shift as the Securities and Exchange Board of India, SEBI, moves to tighten regulations around high-risk futures and options, F&O trading, a segment that has attracted millions of retail investors in recent years. The key question on every trader's mind is, will retail traders be forced out of the market? At the heart of SEBI's proposed changes are risk controls, leverage limits, and margin requirements aimed at curbing excessive speculation, enhancing market stability, and protecting unsophisticated investors from disproportionate losses. Over the past few years, retail participation in India's F&O segment, especially in stock and index options, has increased sharply, with many traders using high leverage to amplify returns. While this has boosted volumes on exchanges, it has also heightened the risk of rapid and significant losses, especially during volatile markets. Under the revised framework, SEBI plans to increase initial and exposure margins, tighten leverage for intraday and overnight positions, and impose stricter risk assessment protocols for high beta contracts. These measures align with global best practices that emphasize robust capital buffers and reduced systemic risk. Exchanges like NSE and BSE will be required to implement dynamic risk models that adjust margins based on real-time volatility and concentrated exposures. So, what does this mean for retail traders? First, higher margin requirements will mean that traders need more capital upfront to open and maintain positions. For many retail participants used to high leverage, this will likely reduce the number of trades they can place and shrink position sizes. The psychological impact is significant. When capital at risk increases, traders tend to become more cautious rather than speculative. Second, intraday trading in highly leveraged contracts may become less attractive. Reduced leverage can dampen the potential for outsized gains on small price moves, which has been one of the chief draws of F&O trading for retail participants. As a result, some traders who relied on high turnover and tight risk-reward strategies may scale back or exit such positions. However, it's important to note that SEBI is not banning retail participation in F&O markets. The objective is to ensure that traders understand the risks and trade with sufficient capital and risk management discipline. Experienced participants with adequate funds and risk controls will continue to operate, while those who were overextended may naturally scale back. For some retail traders, these changes could be transformative in a positive sense. With stricter risk norms, there's less chance of catastrophic losses, wiping out entire portfolios overnight. It may also attract more serious traders who approach markets with strategy and discipline rather than speculation. In the longer term, SEBI's focus on market integrity, transparency, and investor protection will likely enhance confidence among a broader investor base. The derivatives market may see healthier participation, with a tilt toward hedgers, institutional players, and informed retail investors, instead of purely leveraged speculators. In summary, while SEBI's restrictions on high-risk F&O trading will reduce leverage and speculative excess, they will not force retail traders out of the market. Instead, traders will need to adapt, trade with more capital, greater discipline, and stronger risk management, making the Indian derivatives market more sustainable and resilient for all participants.